Before I hand over to Caroline, I would like to spend a few minutes talking about the Commission's international engagement around insurance regulation. I'd like to start with a few words of caution. Firstly, this subject is important, but is just one of the many areas where the Commission is accountable. It therefore competes for scarce Commission resources. Secondly, our ability to influence global regulatory outcomes is always going to be limited due to the bailiwick's relative size and importance. This is not an area where we can appreciably magnify our influence through the Crown dependencies, as Jersey's insurance industry is small and that of the Isle of Man very different to ours. Nevertheless, we do work for Guernsey as much as we can in the space of international policy. The key area is naturally the International Association of Insurance Supervisors, or Iis. Here the Commission is represented in its own right at the Technical Committee and through its leadership of the Captive Working Group. The latter has allowed the Commission to play a key role in fashioning Iis policy around captives, a key industry for Guernsey. The Iis paper on captives was finally agreed by the Iis Exco a few days ago, so we can allow ourselves some congratulations for leading this work in Iis. With the Bahamas, the Commission also currently represents offshore jurisdictions as a whole on the Iis Exco, this being the highest body at Iis. In this role, we can periodically articulate key views, for example, around the extent to which small jurisdictions can implement large-scale policy change. Having said all this, Iis's current main policy interest is in global capital standards, which at least at present have limited interest for us. On the other hand, any eventual international capital standard might well be applied to all insurers, and were that to be the case, it would benefit us to be at the negotiating table. We do, by the way, regularly participate in Iis's self-assessment of insurance core principles. And this is useful to understand where we are in real time compared to our peers. The next global body that we are active in is the Group of International Insurance Centre Supervisors, or GICS, which contains 19 smaller offshore jurisdictions. This is a discussion and peer training group which allows us to understand how peer regulators undertake the sort of specialized insurance business that Guernsey engages in. For example, over the last year, we have considered cat reinsurance and financial stability, the regulatory approach to captive company takeovers, the new UK Insurance Act, and its impact on captives, and so on. As most business is conducted through con-calls or online, and as we tend to meet in London, GICS is not burdensome. GICS is also the main electing body for the Iis Exco seats. We also try to keep up bilateral international contacts for policy purposes. This is helped by our presence at Iis and GICS. Our peers at least know who we are and what we do. One bilateral link is with the EIOPA, or the European Insurance and Occupational Pensions Authority, the EEA standard setter. We may not be subject to EIOPA, but several of our group insurance companies are. It helps everybody to acknowledge that most EEA insurance groups have non-EEA host regulators. Another important link on the bilateral front is with the UK authorities for obvious reasons. This includes the PRA, the FCA, and the regulatory side of Lloyd's of London. We also value our US regulatory contacts. An example of this is our interest in investigating whether we can make Guernsey a sort of preferred jurisdiction for cross-border reinsurance. These contacts help fill in a gap in our everyday supervision. We might reasonably claim to be expert in captive regulation, but we have relatively few general or life companies of any size here. This means peer comparison is difficult. So the more we can understand how regulators with larger constituencies supervise their firms, the more we can ensure that our approach is in line with international norms. Finally, we play our part as global good citizens. For example, we are currently supporting the development of captive supervisory standards in a third-party jurisdiction, funded by the Commonwealth Secretariat. Well, I hope I've given you some idea of the Commission's activity in this area. If we were to become too absorbed in this area, which is easy given the inherent interest and glamour of the global issues under consideration, then we would not be able to undertake our other critical tasks, not least everyday supervision. On the other hand, if we were never to leave Guernsey, both we as supervisors and the Guernsey insurance industry as a whole would eventually suffer. I hope, therefore, we've got the balance right. As is commonly said, you need to be at the table to ensure that you are not on the menu. Thank you very much. I'll now hand over to Caroline.
Thanks, Jeremy. Good morning, everyone. Here's the agenda for today's presentation. Firstly, I want to review what we've been up to this year and report on what we've achieved. Then I'd like to discuss some of the statistics and what they may tell us about the current state of the insurance sector. And finally, look forward to see what we have planned for 2016. So here's a list of the main items I want to cover whilst reviewing our 2015 activity. As you can see, there's a fair amount to get through, so I won't read it all out and I'll just move straight on. So, beginning with the Solvency Framework, which was by far the biggest insurance policy matter we have dealt with over the past few years. The framework was implemented on the 1st of May, and I'd like to thank GIA and especially the Regulatory and Technical Committee for their cooperation in finalising the implementation. We held training sessions for insurance managers in April, which were extremely well attended, and flushed out some interesting questions at a practical level from the people who will have to actually complete the spreadsheet. We allowed until 31st of August for applications for transitional relief, for which actually we didn't receive very many at all, although we have dealt with a large number of queries regarding implementation for specific firms with specific issues, and also with a number of requests for regulatory adjustments. A few of the more eagle-eyed amongst you have also spotted one or two errors or ambiguities in the spreadsheet, which will be corrected or clarified when we release the next version. During the period since implementation, we've been collating all of the questions and comments that we've received in order to ensure that we're consistent in our responses, and also with the intention of issuing an FAQ-type document, which will hopefully assist going forwards. We also want to see if any practical difficulties keep recurring so that they can be addressed within the FAQ document. We've also received feedback from GIA on several issues that had been raised by members since the implementation of the rules. Taking all of these issues, questions, comments into account, we hope to issue the amended spreadsheet and the FAQ document early in the new year. Turning now to our thematic work. This is an integral part of our risk-based approach, which enables us to monitor low-impact firms in a proportionate but effective manner. During May and June, we conducted a review of insurance managers' client take-on procedures. I must stress that this was not AML related, but more about the manager's understanding of the client and its business. This was prompted by a number of applications we received, which were of a relatively poor quality, and where it appeared that the manager did not actually fully understand the rationale for the business. This became evident because the business plan contained large sections simply copied from the client's website, and because each time we had a question, the manager had to refer to the client for the answer. We published the Thematic Report in July, and I'm pleased to say that we didn't find any serious issues, and we did comment on those areas of good practice that were found. I would encourage you all to read the report and consider if any of the issues raised apply in your organisation. One matter I'd particularly draw to your attention is that there were a small number of cases of clients switching manager with the receiving manager making the assumption that a company must be okay if it's already licensed by the Commission. Please don't make that assumption, as it's still incumbent on the receiving manager to undertake full due diligence. There might be a very good reason why the outgoing manager wants to terminate the relationship, so don't always assume that it's the client that wishes to move. A client that falls into your lap without any effort on your part may suggest a client that's desperate to move for the wrong reasons. Thank you to the managers who participated in the thematic work, and to our 2 industry experts who worked on the thematic with us. Ideas for future thematic work include looking at controls around the completion of the solvency workbooks, or at governance around the underwriting process. I'm not sure we will get to these during 2016, as we have other thematic work on banks and conduct to fit in as well, but these are areas we're considering. Last year, we reported to you on the implementation of our risk-based supervision framework, PRISM, and you may recall that the insurance team was the first to implement this framework. Low-impact firms, which would include pure captives, for example, are now mainly dealt with on a reactive and thematic basis. And now that the online submissions portal is up and running, annual returns for those companies will shortly be automatically assessed for certain key risk indicators, as Stephen explained this morning. Where an indicator is triggered, you may find that we will revert to you for further information. We've now completed an in-depth review of a number of high, medium-high and medium-low impact firms, and have found the process to be beneficial from a supervisory perspective in really understanding the firms. The firms involved have all embraced the process constructively, and we hope that they have also found it useful and not too onerous. There are a number of themes emerging from the full risk assessments that we have carried out this year. In relation to corporate governance, the findings have generally been good in relation to the balance of the board and the level of oversight and challenge provided by the board to senior management. Remuneration policies are generally appropriate and not overly dependent on business being generated. In a minority of cases, we've identified key man risk, especially in smaller commercial insurers. In relation to companies that are part of larger groups, the level of group influence is evident, whether in the systems and controls or in the presence of group representation on the board. This is not in itself a problem, providing that the Guernsey entity retains a sufficient level of engagement to ensure that local issues are not overlooked. Fundamental issues, such as business models, are often established at group rather than local level. But it is essential that the Guernsey firm understands their group model and their contribution to that model. Where functions are outsourced to other parts of a group, the Guernsey board must retain sufficient oversight of that function by implementing effective systems of review and audit. Technology is playing an increasing role for many companies, and we have observed that issues can arise when a company fails to keep pace with developments, both in internal systems for management information and in its distribution networks. A key element of our risk assessment centres around the business model and strategy of the organisation. In cases where a firm is offering a niche or specialist product, then competition is the biggest threat to their business, because they do not have the ability to diversify if their core market becomes unsustainable. It is inevitable that a profitable line of business will attract competition, and firms need to plan ahead to deal with that, whether to decide to compete with cost cutters or to sit back and wait for them to fail. The banking and insurance teams are continuing to integrate, and this year the banking supervisors have embarked on an IAIS-related course in insurance supervision. They will, of course, then need to get some practical experience, but they should be able to transfer their experience in prudential supervision and their existing skills in risks such as governance and conduct, and of course their existing knowledge of PRISM, to the insurance sector. So this will leave us better resourced in terms of insurance supervision in the future. I wanted to say a little bit about our engagement with other regulators. Whilst this is useful to us in gathering information and understanding more about group issues, it is also beneficial to the reputation of Guernsey. In the same way that, as Jeremy outlined, our international work is helpful to the profile and reputation of Guernsey, so too is our attendance at supervisory colleges. We can underline our credentials as a competent and cooperative supervisor by engaging with other regulators on an equal footing. It is also an opportunity to benchmark ourselves against other regulators by observing their supervisory processes. During the year, the supervisory team liaised with other regulators as appropriate, whether by telephone, email, or by attending supervisory colleges where relevant. We attended 2 colleges and had bilateral meetings with 2 other regulators. Exchange of information is done on the basis of Memorandum of Understanding, either the Iis MMOU, bilateral MOUs, or firm-specific MOUs. We're starting to see group-wide supervisors developing their approach to group supervision, and therefore we expect this level of interaction to continue to increase. Turning now to the Authorisations Unit. The unit was set up earlier this year, and we're grateful to John Dunford, who's Deputy Director of that unit, for joining us today to deal with any questions you might have on that topic. All new applications are now dealt with by our dedicated Authorisations team, so you should contact them in relation to any potential client meetings or the application process. The supervisory team also remains happy to meet with potential clients if necessary, but your first port of call will be the applications team, and they will assess whether we need to be involved. The unit has full authority to approve applications, but they will seek input from the supervisory divisions if there are any particular issues or if the application raises an issue of policy. Once licensed, the company then comes under our supervision. All PQs and new director or controller appointments are also dealt with by the authorisations team. And they'll also deal with other items requiring formal commission approval, such as change of name, change of auditor, or change of year-end. Migrations in or out, conversions, and surrenders will also fall under the authorisations unit. They'll refer to the supervisory divisions as necessary, particularly for anything involving a firm that is anything other than low impact. Also importantly, as you may have already heard this morning, the unit is home to the help desk, and the telephone number is on the screen for you. This is the help desk for the online portal, so you can call them if you have any issues around any of the online services, and they'll be able to assist you. So what is the ongoing role for the supervisory division? Well, as I said, we deal with the ongoing supervision of each licensee. This will involve items such as business plan changes, annual returns, modifications to solvency rules, and any other waivers that you might seek, breaches, general inquiries, and also from time to time dealing with firms that find themselves in difficulties. And we also deal with policy areas such as the implementation of international standards. Jeremy's already mentioned the Iis Captive Paper, and during this year we concentrated some resources on getting this paper finalised and adopted after 3 years of work on our part in leading the drafting group. It was overtaken on the IIS agenda in 2014 by the huge amount of work on solvency and capital standards that the IIS was working on. Having got it back onto the agenda this year, we wanted to make sure we saw it through to adoption. The paper went to the technical committee in June 2015 for approval to go to public consultation. The consultation then took place during July and August, and comments were received from 12 parties, 5 of whom were supervisors, and the remainder were firms or industry bodies. After amendments take into account some of the comments, the paper was re-presented to the technical committee in September and received approval. And the final process was adoption at the annual meeting, which has just happened last week, and therefore the paper will shortly be published on the IIS website. This is an important piece of work, as it helps to establish captives as legitimate insurance vehicles, and Guernsey is seen as the expert jurisdiction in this area by our peers at the IIS. As part of our preparation for any external assessments of the jurisdiction, we're committed to taking part in the Iis self-assessment and peer review process, which this year has covered the ICPs listed here. I'm pleased that we received ratings of largely observant in relation to ICPs 9, 10 and 11, which cover supervisory measures. ICP 9 deals with on- and off-site reviews and information gathering powers. ICP 10 deals with preventive and corrective measures, such as, for example, the imposition of licence conditions or restrictions on writing new business. And ICP 11 deals with enforcement powers. We await the results of the self-assessment of ICPs 18 and 19, which deals respectively with the regulation of intermediaries and conduct of business by both intermediaries and insurers. We had hoped to have the results of this by now, but the IIS is still working through the results, as so many jurisdictions took part in this assessment. Our self-assessment of ICPs 14 to 17, which are all encompassed in our new solvency rules, was submitted in October. Results of these self-assessments are not expected for several months yet. So let's have a look at some recent statistics. For the year ended 31st of December 2014, the market remained fairly steady, although there was a slight growth in written premiums, as you can see here. We did see a slowdown in new business during the first half of 2015. However, applications have begun to pick up again in more recent months. Indeed, October was the best month so far this year. For the period to 30th of September, there was net growth of 9 entities, with 51 new entities licensed or authorised. This slide shows the trend in new licences issued. As you can see, there was the drop earlier in the year, but this has recovered slightly, although not quite back to previous levels. Insurance-linked security business still accounts for over half of new sales, and there are also a number of after-the-event legal expenses sales this year. Other notable licences issued this year include a substantial new reinsurer and a company writing sports risk. We're aware of several ongoing inquiries in relation to pension longevity risk, and we hear that there was great interest generated by the Guernsey finance event in London in October, and we hope that those will come through during the course of next year. So, looking ahead to 2016. Firstly, I'm sure you'll be pleased to hear that there are no major policy developments planned for the year as far as insurance is concerned. I can assure you that's also a relief to us. We need to embed the new Solvency Framework, and as I already mentioned, we'll issue FAQs and an updated spreadsheet in early 2016. We'll undertake a more comprehensive review in 2016 once we have the bulk of the annual returns from December year-ends to analyse. This will inform any future refinements in the Solvency Framework, and of course we will continue to discuss these with GIA. Annual return regulations will need to be reviewed in due course to reflect the reality of the new online submissions requirements. When you come to submit online, you will notice that some of the items you currently submit are no longer required. But please don't worry about that. We've been able to dispense with some items which we feel are no longer necessary. The regulations will need to catch up in due course, but such secondary legislation will need to wait until after the revision of laws. As I mentioned earlier, to a large extent, the returns for low-impact licensees will become automated, and the system will alert the supervisor if one of the key risk indicators that we have set has been triggered. The Corporate Governance Code will now become an annex to the Finance Sector Code. We have discussed and agreed this with GIA, but need to ensure that we follow the correct process for amending the Finance Sector Code, and therefore will update you on the timetable for this shortly. We will implement for financial years beginning on or after, hopefully 1st of April next year. And we intend to implement it so that no company should be dealing with the 2 separate codes in one financial year. We of course also need to keep an eye on developments at the Iis. Their roadmap of activities for 2016 includes various capital standards aimed at internationally active insurance groups or systemically important insurers. There is, of course, always the danger that these standards, once established, will filter down to apply to other types of insurer. The common framework continues to develop in conjunction with the capital standards and with ongoing work on updating the insurance core principles. Recovery and resolution is also on the agenda for 2016, together with evolving thinking on group supervision and further work on how proportionality is woven throughout the insurance core principles. Although we don't anticipate any major issues to affect us during 2016, we will need to monitor the ICP updates, and this will also form part of our preparation for an IMF visit. Not because we intend to plug every gap, but because we need to be aware of where those gaps are in order that we can arrive at sensible decisions about whether they're relevant for us. Earlier this year, at the request of GIA, we began to explore the possibility of Guernsey applying for qualified jurisdiction status in the US as a means of mitigating the collateral requirements often imposed on non-US reinsurers. The process is based on a model law on credit for reinsurance, which was developed in order to reduce the barriers to entry caused by the collateral requirements imposed in the US. We made initial contact with the NAIC to find out a bit more about the process, and we now have some idea of what might be involved. In particular, that we would need a reinsurer to work with us as part of the process. There would undoubtedly be a lot of work involved, both for the Commission and any reinsurer involved. And the benefits are not automatically applied, even if a qualified jurisdiction status is granted. It's not yet clear whether the industry demand or appetite exists for us to proceed with this, so I will leave that one for you to think about, but the Commission is happy to explore this further in the future, should you wish us to do so. Well, that concludes what I wanted to say today, and I'll now take questions along with Jeremy and John. Thank you.